Maybe.
5:30 maybe. Well, we have our special guest, Monty Walker, who is in the Texas time zone. So that is an hour earlier to begin with. So I appreciate him getting started early. I know it is a bit early, but we try to get our meeting started early and end it early. This way we can go on with our day. So we're going to get started. I wanted to thank everyone for attending. We have some folks still attending, but we wanted to get rolling. I'm Anthony Citrullo. I'm the current year president of the New York Association of Business Brokers. And I wanted to welcome everyone and hope just in advance, hope that everyone has a great holiday season, a Merry Christmas, a Happy Hanukkah, and any other holiday that you in fact celebrate. We hope that you enjoy it. I know it's been an interesting year, somewhat of a stressful year for everyone, and we're looking forward to having a great start for next year. But today we have a special event, and it's really, I mean, I want to thank Vishal, our Vishal Baruka, who takes care of our topics and our programs, and he said, let's talk about the folks who are looking to be in the mid-market, lower mid-market. A lot of them started in Main Street type businesses. And we're going to be discussing that today with an expert on that, and especially on the tax side of things, Monty Walker, and as well as my partner, Kyle Griffith. And anyone else who has comments as we go along are certainly welcome to offer them. I just want to go over a few things. The New York Association is concluding the 2020 here. It's really kind of been a good formation year for us after what's going on with the pandemic and everything. And I think going forward, we have a lot of good things planned for the organization. You'll see us with an enhanced and an updated LinkedIn group. We are really looking to have a greater web presence with the organization. We have our website's being redesigned, and it will be found. And I think that one of the benefits of being with the association is to be found and be as a NYABB member on our site. We will be sending out some information as regards to membership, and we hope that each of you take that seriously and join us, because there will be some members only benefits. We have a new listserv that we're working on that Kingsley has initiated, and it's going to be a great opportunity for us to share information back and forth among members, get questions answered. We have some professionals who are going to be able to post on it as well. We're working on some special course offerings for NYABB members, including a recasting of financial statements course and a special course on lending in today's economy. And we have somebody who's going to come in and talk a bit about franchising specifically for our membership. In addition, we have a monthly newsletter that'll be going out. And we are working with several of the other chapters to do some regional and some cross-networking so that you get to a little flavor for what goes on for the rest of the country. There are some very robust business broker organizations out there, not the least of which is the one Monty's in Texas, and folks in Florida and California. I'm on a call with them on a regular basis. I think there's a lot to be learned and a lot to be shared there as well. And we are planning a conference for probably when we can plan a conference, right? We really want to do one in person later in the year of 2021. So we're hoping that'll happen. If we don't, we will do it virtually. And we are working on a member dashboard for our past webinars as well. So there's a lot going on there. And at this point, what I wanted to do is just introduce our board. And our board consists of our VP is Greg Carafello, and Greg, if you have a second, can you say a couple of words also concerning membership and what we're doing in that direction? I don't know if you're there to be seen or had. I see him in a box. Okay, we're going to hold off because he's on, but probably figuring out how to unmute himself, perhaps. And the rest of our board really consists of Vishal Baruka, who takes care of a lot of our programming, Tony Torella, Ed Telling, Fred Swint, Kingsley Allison, and my partner, Kyle Griffith. So Kingsley, are you around? Are you there, Kingsley? everybody's here, but on mute. So
Yes,
there
I
he is.
am. Yes, I
Kingsley,
am.
can you just talk a little about the listserv and where we're at with that? This way everyone knows how we're progressing.
Well, it's there and it's up and I guess say about 7 or 8 people so far that respond to to opt in. So you have to opt in to be a part of it. So for the people who didn't respond, I don't know if same thing happening to them that happened to you, where
Right.
I send
So
the
I would say
information out and
anybody
just
who's
didn't get it.
interested in Kingsley,
Yeah.
can you put your contact information in the chat? And then anybody's interested in being part of the listserv, please contact Kingsley directly. That would be
Okay,
terrific. Okay.
I'll do that.
The listserv will
Okay.
help us do that as well. So, okay. And we'll hear from Greg later, I think. So without any further ado, what I'd like to do is introduce the folks who are going to help us on this panel. And what we're talking about is moving from Main Street to middle market, and specifically lower middle market. A lot of us who've been in the business for a while started out as Main Street brokers, and Main Street is exactly what you think it is, essentially taking care of businesses that you can kind of see and feel and touch and go into. And for the most part, many of them, some of them are higher volume, many of them are lower volume businesses, but certainly need the assistance of a professional intermediary, of a professional broker. And many of us have moved up the food chain, so to speak, in looking at larger businesses, which we would consider lower middle market. We'll talk about what that means. And but our special guest panelist today is Monty Walker. Monty is really a key go-to resource in the industry for anyone that needs assistance with a deal structuring. He has a high level of special expertise when it comes to tax. He's really, business transactions. He's a CPA, but he really knows the transaction world. He's authored a course on tax implications of the business transfer. He's both a certified public accountant, a CPA, a certified business intermediary, and a certified global management accountant. And he's a member of a lot of organizations, including some of the most notable being the AICPA and of course the Texas Association of Business Brokers, and several others. So he's really a subject matter expert for the IBBA, which is the International Business Brokers Association, in the area of business taxation, structuring, and planning. And he's been teaching for many years. I won't say how many, Monty, but probably a few years you've been teaching courses, right? He works, he teaches for the Texas Association of Business Brokers as well as the Texas Real Estate Commission. So he's well versed in a lot of different things and knows our industry very well. The other person on our panel is my partner, is Kyle Griffith. Kyle, he's a certified business intermediary, which is a CBI, and a certified merger and acquisition professional. He is now on the board of governors for the IBBA, which is the International Business Brokers Association. He's co-chair of the member engagement committee for the IBBA. He's well known in the industry, in both the M&A and business broker industry. He actually had the IBBA Outstanding Producer Award for 2017. So outside of that, he's the managing partner of our firm. We run the company together, and really a real asset to us. So I welcome both Monty and Kyle. And, I'd like to just start the conversation for those folks who are on the call. They may not really look at it, but, if we're talking about the lower middle market, maybe Kyle, why don't you start? What would you determine that to be? If you wanted to take a look at size, industry, perhaps metrics, what would you think? How would we describe that?
Well, when we put out the market pulse started about 13 years ago, 14 years ago. And at that time, the powers that be had determined that Main Street businesses are businesses with enterprise value up to 2 million. Obviously, that's always debatable, right? But that's just a general rule of thumb. Valuations, enterprise value up to 2 million, and lower mid-market between 2 and 50 million. Now, with that being said, you can work on a smaller transaction for a business that's saving 500,000 or under $1 million that could have some lower mid-market parts of it. So it's not only the size of the company, it's also the sophistication, the type of business, and the structure of the deal, and what you need to bring to the table to get the deal done. So you could even work on a larger company that could still be considered Main Street. So it's a gray area. But for a good general rule of thumb on the valuation side, you look up to about $2 million Main Street, and above that, lower mid market. On a revenue, if you look at it from a revenue standpoint, typically above $5 million to up to 100 is low mid market, but that's debatable. Depending on who you're speaking with, what part of the country you're working in, and the type and nature of business.
And Monty, what would you think? I mean, you structured a lot of deals. I guess there are some complex Main Street deals too. I mean, when you look at middle market, what's really kind of the differentiating factor when you say, hey, listen, this is more of a Main Street, this is more of a middle market deal, and what are some of the nuances that you come across?
Kyle did hit some of that. He's correct. When we start looking at, especially coming out of the IBBA, M&A Source, that kind of coalition of group, 2 million seemed to be a number. Ironically, now that thing has kind of dropped itself down without placing it on paper. We see a lot of transactions that are 1.2, 1.5 and under that are still considered Main Street. The complexity, the complexity that happens, that's a morphing. I like the way Kyle put that. It all depends. I mean, it's a gray area, and Kyle's right. Everything in this that we're talking about now is gray. Where does it stop? Where does it end? But I can tell you that when it comes down to structuring, you will find more integrated like equity elements coming into play as you move up the scale in terms of value. The buyers that will be in that Main Street area, you're going to have a lot of people buying businesses that are their jobs, but you're going to have corporate executives that start in that area also. We move up into the lower middle market. Now we have corporate executives that have some money that they've accumulated, but we also have private equity groups, corporate strategic buyers. Well, as a result of that, now we do have some creativity and structuring issues that come into play, more equity elements that can come into play. And you're going to find, as one intermediary just now did, a lot of my advisory work I do with other intermediaries. So I got a call on this. The buyer wanted to convert the company to an LLC. I mean, they had to do it. If they were going to buy the deal, that thing was converting to an LLC. And so right before the transaction went down, that thing happened. Now, you think about it. What in the world can that create in terms of problems or complexity? How do you deal with a seller trying to get their hands around that? And more important, how do you deal with the advisors that are advising your sellers on that? Because when have they ever seen it? So the complexities get a lot, they begin somewhere around that million mark. But certainly this type of stuff will probably encroach greater as you move on up the scale, 2 million. But I can say right now, if you're looking to lower middle market, everybody on here will probably at least be below 5 million. And anything we're talking about right now, the complexities, it's all right in here. So you got to get yourself more versed on structuring issues.
I think what happened a lot to Monty and Anthony, everyone else that's listening, because of the lack of inventory, the lack of good solid deals, you've seen a lot of these private equity groups and family offices that are coming down market.
Yep.
So they're bringing their lower mid market and mid market transaction structure terms and just a sophistication of working on deals. They're bringing it to the Main Street market, and because of that, you have to be prepared. So if you're dealing with a large family office or a large private equity group, you're not going to come to that deal with a solo attorney. Typically, you want to match strength with strength, and you want to be able to advise your client accordingly so you can get the best price and terms for their business. So that has changed lately because we've seen a lot of these buyers that are looking at smaller deals now because there's not as much inventory as they had in previous years.
Yeah. What happens is they show up where you're on the Main Street, where you're accustomed to having a due diligence list that might be a page and a half. I mean, something relatively small. Now they show up with 30 pages. And why? Because it's just it's common for them. They throw it out there. It overwhelms you. And immediately what happens, the seller gets so upset and mad because they're having all this stuff thrown at them. And somehow you got to just know it's just the way it is. This is just the life that you have to live when you start moving up. And Kyle's right. It moved now that they're moving down. Some of the bigger guys are moving down into the smaller deal structure. They're bringing all the complexity with them.
Yeah, I'm working on a deal right now. It is a Main Street deal, but it's being done in a low mid market process. I mean, we have working capital considerations, worked into that, and it's because the buyer, they want to make those accommodations. They want to true up working capital, allocating the price beforehand. Typically in a Main Street deal, the asset allocation or price allocation is done at the tail end of it, but low mid market deals, all the working capital and the price allocation is done usually done ahead of time, and even how the deal is structured between asset or stock sale, a lot of that is pre-planned prior. So so this deal is under $1 million, but it's going through that low mid market process. The company that's purchasing this company, they are a platform company. They've made 3 acquisitions, and they're running their typical acquisition process. They're not going to change their style because they're looking at a smaller company.
Yep. And what happens? Costs go up, right? Because now the sellers are having to pay more for their advisory people to support them. So costs are going up right along. So the intermediary is a responsibility to organize that and to prepare them mentally for what's going to happen.
I think there are a lot of not just nuances. There's nomenclature. There are different terminology that folks have to get used to, especially if you're used to Main Street type of transactions. So one of them that Kyle mentioned is working capital. I remember the first transaction we did that was more of a lower middle market transaction. They go working capital. I go working what? It's funny because you never really, and not that I didn't understand the concept, it's that you never considered it in really a Main Street deal. There was no working capital. What it was is you transferred the assets of the business, whatever cash was in the bank account became the seller's account, whatever receivables there were, if it was a receivables business, were the sellers, and then the buyer just kind of was on his own or her own in order to run the business. So, when you look at things, so there are other things to consider. So working capital is one of them. And for those people on the call, Monty, can you kind of just give an idea of what somebody looks at when they're thinking about working capital?
Yeah, well, first of all, let's just get clarity on this working capital. If a business is going to be sold as a going concern, and we all have to agree one thing: if you're selling a business, you're selling a going concern. You're not liquidating. That's not what you're doing. You're selling a going concern. A going concern has the capacity to when it opens the doors the next morning, it has the capacity of paying all of its bills, taking care of its obligations, being able to react to market conditions. It has the ability to do that. So when you determine the value of a business, and you're determining the value of the business as a going concern, that's an element of it. It's just the reality. Now, Main Street businesses, and we'll just say I'll cut that off around 750 grand and under. Up to that, people are buying jobs. It's a de facto. They come in with their own working capital. That's what they're doing. Above, when it starts around 750, now that's not written in a textbook anywhere. I'm just telling you what I know from what I've been dealing with for 25, 30 years of this stuff. Okay. So right around in there, then we start seeing working capital becoming something that's an expectation. Now, what Anthony's talking about on the working capital itself is the resources that have been absorbed, cash resources that have been absorbed into the business. And that would be inventories. That's going to be accounts receivable. If you're doing construction, it could be work in process or even manufacturing, the WIP that's going on. You will have account payable, specifically vendors, for those particular costs. So when you deal with working capital, you got at least initially, you got 3 elements that you have to deal with: accounts receivable, inventory, and then your account payable that comes into play with that. And then from there, we branch out. So you notice I didn't say cash. You don't calculate the working capital based on the cash. You based it on those. Now, people may want cash as an element or a piece of their working capital. So if you calculate working capital and you come up with it takes 500,000 of working capital, the buyer may say, okay, great, but I don't want that in account receivable, or I don't want all of that in inventory. I want 100 grand of that to be cash. So you determine what it should be, then you determine the elements that it comes into play with it. And so when they open up the door the next day, it's part of the value. If you strip that out, your value drops on your business. And I can promise you this, if the value of if the working capital requirement's 500 and you strip it 500 out, that doesn't mean your value drops by 500. It's going to be bigger than 500 because the business is not going concern anymore. So you have to think that through. And one last point I'd make on this, and Kyle was referencing that in this purchase price allocation thing. Purchase price allocation becomes a real issue with these businesses as you move up, and especially working capital. When you sell a business, any liability assumption becomes a part of the transaction price. So let's assume that you are running a calculation on working capital. You have 800,000 that ends up being accounts receivable, and you have 500,000 that's accounts payable, just as an example. So the net is 300 grand. Let's assume that you have a $2 million deal. Well, if your working capital is 800 AR and 500 on account payable, now you've got 500,000 that is an assumed liability. Your deal allocation is no longer 2, it's 2.5 million. That's the kind of complexity that you run into. And I can tell you that I was dealing with somebody from your state. New York's got a lot of sophistication. I think we can all agree. It's got some big taxes too, but it's got a lot of sophistication. Doing it with a highly sophisticated attorney on a deal recently, and on all his career, he had never allocated that, and I had to show him the tax regulations that mandated it, and he acknowledged that just changed his whole approach on allocation. So you have to allocate the payables or other liabilities that get assumed as a part of the working capital. So just know that complexity, working capital, going concern, they all intermingled as you move up the scale.
Monty, you make a good point there. Like, you have to factor that working capital into the price ahead of time. So, because the buyer is going to want that to stay in the business. So you want to factor that into your final price. And in your example, if there's 500 grand, and correct me if I'm wrong, if there's 500 grand of working capital, you want to add as much as that you can. If the business is a $2 million business, you want to factor that in to that price, because that will be negotiated. And it may take 2 or 3 months to true it up. The buyer may want to sit in there and say, well, okay, well, after 3 months, we can true up working capital and figure out exactly what it is after I'm there operating the business myself. So it can get a little bit complex, and this can be a huge deal killer. So you want to have that understanding up front and positioned that way as such. And
Yeah.
you would need the sellers, a CPA, an attorney. That's why when you start dealing at this level of sophistication, you want to have those conversations, these hard fought conversations with your client and their professional team as well, because
Yeah.
you don't get to the closing table and have this conversation, because it's not going to happen.
That's right. You're going to set the tone up front. And I don't want to belabor the issue on working capital, but I can tell you right now, accountants, their CPAs that are advising your clients, they do not understand this working capital thing. You would think they do, but their approach to working capital is current assets minus current liabilities. And why? Because they got taught that when they were being taught accounting. And why is that? It's a balance sheet calculation. It has nothing to do with the required working capital that's integrated into this. Because you need to keep in mind, working capital is a cashless, debtless item. That means the liabilities that are associated with account receivable and inventories are what comes into play. And these accountants do not have that under control. So you're the one that's going to have to set the stage and providing guidance to these people and making sure they get their expectations under control. Because it's not going to be their accountants. You're probably going to school the accountants, very likely.
If I may add on to, I mean, most of us that are in the business, we're used to recasting financial statements. That the balance sheet needs to be recasted as well, because it's a possibility that your client may have excess assets, and we have to figure, okay, well, do we have to recast their balance sheets, because they may have too much assets in there, and the buyer is going to want those assets. So you may need to, if they have slow moving inventory or dead inventory, you need to get rid of it. If they have excess cash in the business, they may need to start taking out some of that cash. So because when it comes to the closing, the seller wants to give up less working capital, whereas the buyer actually wants to keep that in the company. So Yeah, sorry if we beat that that horse too
That's
much.
why, you
but,
know what,
it
guys,
is
I
a deal
mean,
killer.
everybody we speak to now is, the comment is, how are we going to buy the business? We're going to buy it cash free and debt free, to your point, Monty. And then that means that essentially the cash should get, scooped out of the account by the seller, depending on what the working capital is. And they're not going to assume any debt typically, especially any long-term debt. But everything else on the balance sheet, they're buying. They're buying the balance sheet. And I think sometimes people don't realize that they are buying the balance sheet. And that's one of the significant differences, I think, between when you're doing a Main Street deal or you're doing a middle market deal, you're doing one with a more sophisticated buyer. I think that's one of the big differences. I think one of the other differences too is in terms of how they structure the transaction, not just from a tax standpoint, but also from a debt standpoint. We've seen different tranches of debt, and a lot of times they want to sell it to have a note. And maybe you guys can address typically what you see in terms of deal structure, especially when a private equity firm is buying the company. They're not necessarily putting all of their own equity in. They're using other equity. And maybe you can address that, Monty.
Yeah, they almost exclusively, when the private equity groups come into the table, they're leveraging. Private equity does not do what they do it well by just having accumulation of cash. They're leveraging. They're bringing people's money. They may be a private group representing a small exclusive group of investors. It could be representing maybe a single large investor, but they're going and they're getting lenders to leverage. But when the three-legged stool is coming in, it's almost consistent. You will have if a peg's involved, they're probably going to have a cash element that they're coming to the table willing to bring. They're going to have a seller note requirement, some kind of financing element that they will have, and it's not uncommon. It's very common to have an equity element on the roll. So they're going to come in and they're going to expect that the sellers will stay involved. Private equity, their objective isn't trying to just come in and take over. Even if they're expanding, using this as a platform, or if they're doing an add-on, they still want management involved. So where in Main Street, you're getting rid of all that. Where Main Street, where SBA is driving the deal, and then you find that their owner cannot stay any longer than 12 months. Private equity's not going to they're not going to SBA. They got a whole different avenue. And we're talking even deals that'll be $2 or $3 million. So don't think we're talking something that's a $10 million, $15 million deal. No, this is still where SBA would fund a $2 to $3 million deal easily. Private equity's moving down into that, and they're doing the same thing. So just expect it. They're going to expect probably a cash element, a seller carry in some form, so they have risk on the table, and they want to hang them in there. And so they're going to have an equity piece that they're going to expect them, and they call it an equity roll. And what happens on that is, if you don't do it right, next thing you have a seller that's getting taxed out the rear, because now they can get taxed on the equity roll if it's not done properly. So the sophistication that comes into play just on that piece alone. But those three are going to be there for certain, almost always.
Yeah, what we have found is, and Kyle, I'll let you go in a second, is for every dollar that the private equity was putting in, there's some multiple that they're getting senior debt for the most part, and so they're coming in with that. In addition, they do always want a seller note of some sort. And the equity roll, for those who don't understand, is they want the existing owners who are going to stay running the company to retain equity in the new company, in the new co, as we say. And our experience has been, they like them to have about 20%, but I guess that's negotiable in a lot of cases. So here you have a seller who, just so you know, is not necessarily, maybe they're selling the business for $5 or $10 million. At the closing table, they're not getting $5 or $10 million. They're retaining typically some kind of seller note, right? And the second thing is they're probably reinvesting 10 or 15 or 20% back into the company. So you figure out what the numbers end up being. And the thing, Kyle, I just wanted to talk about is that seller note is in second position, right? In terms of guarantee. So, I mean, what does that mean to the seller?
That means they don't get their money until the private equity financiers get their money.
So, and a lot of sellers, Monty, a lot of sellers don't like that, right? They go, gee, why, none of my money is guaranteed at that point. And there's not really a lot of recourse for the most part. I mean, what's your response to those guys?
Yeah, I could say one of the things that happens on the seller note, and you do have negotiating room on this, it's common that a private equity group they will want to pigeonhole directly in the link for what they're dealing with at that point. Private equity, this buy that would be happening with your seller is not the only deal they have. So they've probably got other deals that are out there. So you can negotiate for that note to have collateral positions outside the scope of the downlink or the upline that's happening on the deal. But it's not normal. It probably won't happen. If a PEG's involved, there's no personal guarantees on the note either. So now you're sitting there with no personal guarantees, very likely on the note. It's taking a junior position somewhere. So your thing is, can I negotiate this to branch away from just that one line that they're working on? Typically, that's going to be how valuable your seller's company is to what they're doing. If it's a platform deal and you know it, then you probably have a lot of room to try to enhance their collateral position. If it's just an add-on, we can get an add-on somewhere else. They probably won't listen so much. So you just got to know where you are in the link.
Yeah, so these are some of the issues you never really see in kind of a Main Street deal for the most part. I think that's what we're trying to bring across. I think one other thing I want to talk about is the financial aspect. So we, the first time we were doing a transaction that was a larger transaction, they go, we need to go do a quality of earnings. And, quality of earnings, you don't really see a quality of earnings on a Main Street deal, okay? For the most part, you could, but you don't usually see a quality of earnings. I think two things. One, I want to have people understand what that is. And also, a lot of them want, their financial statements in GAAP. They want them to be according to GAAP. They don't want them to be some other form of financial statements, which you may see non-GAAP statements, especially in a lot of Main Street deals. So, Monty,
or no financial statements at all.
Or no financial statements. So both of you guys, can you talk about quality of earnings, what it is, and what the expectation is there? We like our sellers to get a quality of earnings before they start the transaction. This way they know what their expectation is. And then I want to just talk a little bit about financial statements, trailing 12 months, and GAAP, so that people know a little bit of the differences, especially between the Main Street and kind of the mid-market type deal. Monty?
I'll let Monty take that one.
All right. First of all, it's the quality of earnings report. The whole objective on that is so that each period of time that's being analyzed, that it really has the earnings represented in that time frame that belongs there. So a great example, somebody may write off inventory, but that inventory should have been written off 3 years ago, but they do it in 3 years later. Well, the quality of earnings would stipulate, no, let's get the earnings in this period to be represented properly. So you take it back in time. Or maybe somebody has earnings that they've recorded in a current period, but they should have under accounting rules done it several years ago. Well, that makes a current period look bigger. So the quality of earnings is to try to absolutely get that matching down, and it's supposed to move out of any particular period income should not even be reflected. And that can so quality of earnings is really what it is. What's the quality of the actual earnings being represented in the period analyzed? We want to get the proper matching in place, and it's not uncommon. Things can change dramatically in these companies. Now, GAAP. These companies are, the bigger the deals go, and the more likely you have a private equity group or somebody coming in, they're going to show up and say that they want generally accepted accounting principle financial statements. The fact is, if your client hasn't been doing it, you can't let that ride. You can't just go, okay. Will they bend? Yes, they will bend. If you go back and show the entire history has been cash basis or tax basis, they haven't been producing GAAP. They haven't had to produce GAAP. Going back and doing that's just not going to be feasible. So what they have to do is say that financial statements will be based on their historical accounting practices, and you can get that accommodated even when when a private equity group is coming to the table. If you do not have somebody that's been producing compiled financials, they haven't had any reason to produce a GAAP-oriented statement, then trying to make that happen when somebody shows up at the table who demands it, it's just unreasonable. So when you just can't let that happen. Now, it is very common, as Anthony mentioned, to have trailing 12 months. That's something that's going to happen even in smaller deals. As a matter of fact, if somebody's being properly analyzed and you're trying to get an understanding of their earnings stream, you'll want to know what their trailing 12-month time period is, because it gives you an idea. Are they going up and down? How about this trailing 12 months or the same trailing 12 months in a prior year, all that stuff. You want to know that. But if a buyer's coming to the table, they're going to use trailing 12 months in this lower middle market to help ascertain the working capital. They're going to look at that over a 12-month period. The trailing 12 months is going to have something to do with the earnings flow that is going on. We want to see what the real earnings are. So the trailing 12 months is a critical item. You don't just take what's been currently happening and compare to last year like you would in the Main Street. This trailing 12 month is a big, big indicator. As a matter of fact, when you start looking at multiples, the private equity guys especially, they'll start looking at multiples of trailing 12 months. What are we willing to pay? Let's look at the 12 months it's happening. We're willing to start there with our multiple, and we'll adjust from that point. And it's based on EBITDA. So we're not doing just purely seller discretionary earnings. Now, with that, I'll say this. Earnings before income tax, depreciation, and amortization is just a fancy way of saying seller discretionary earnings. Okay, it just is. We call it something different in Main Street, but EBITDA is where they're looking. So you have to change your terminology. I think, Anthony, you made reference to terminology earlier. We have to look at EBITDA, adjusted EBITDA. We start moving away from the concept of seller discretionary earnings. No, it's essentially the same type of thing, but we call it EBITDA. And then when we're looking at EBITDA on a 12-month trailing, they do multiples off of that to establish their price. So it's super important you get your sellers in motion to understand it and hold firm to non-GAAP financial historical accounting if you can't get that done, because if your client hasn't been doing it, GAAP financials is probably not going to be feasible.
Kyle, if you want to just enhance, just so everybody understands what trailing 12 months looks like, in terms of, what that actually means, because sometimes that may be a term that you don't see much in Main Street. So maybe some folks, excuse me if everyone understands, but just explain that to everyone.
I mean, to make it, as simple as can be, a lot of times the client will give you your previous year returns. You want up-to-date financials, and the trailing 12 months or the previous 12 months is the most recent financial statements, as opposed to 2019 statements. You can see how they were the last 12 months. You can look at the seasonality of the business as well, and so on. So we tend to get month-to-month statements as well, including with the trailing 12 months, as well as tax returns and their annual financial statements.
Yeah, that's true. That's true. And folks I'm sorry, Monty. Go ahead.
Let me just throw one thing on that. The accounting programs, and even the accounting programs that most of these companies will use, and many of them, ironically, as you would think wouldn't be the case, they're using QuickBooks. I mean, even in this lower middle market space. Okay, so just knowing that, you can actually ask and request that they provide you a 12-month trailing. What you're asking for is a financial statement that's produced on a monthly basis, so that you can ask for that. They can export from their accounting programs the data that you need. Now, I'm not saying you may not have to do some adjusting to get, how these entrepreneurs are. They'll manipulate data, but you can export that data and get that in the columnar format, 12-month trailing. You can even ask for 36. As a matter of fact, when you're analyzing data for your clients, you should be requesting, I want to see your last 36 months and have them export that directly into an Excel spreadsheet. You can do that, both balance sheet and income statement. You can do both of those. Of course, it's called profit and loss inside of QuickBooks.
Right.
I mean,
So it's pretty easy. It's a pretty easy.
Actually, they want to see a 10-year history sometimes, because they want to see how the company has fared like in the last downturn.
And I find it's a pretty easy. It's a pretty easy get. I mean, back to your point, Monty, for the folks who are using QuickBooks, I mean, they really just have to know how to run the report. The other thing we find is not everybody reconciles on a monthly basis, so you may have a lot of ebbs and flows there. You may not have a lot of consistency. I'm sorry, I interrupted you. What were you going to say?
No, that's right. I was going to say the same stuff. Yeah.
That's what I find. So that's the financial part. The last thing I want to talk a little bit about is kind of diligence and security, and basically how information is transmitted. So I know, many of us use secure data rooms. That was something that, was, I hate to say, when we were in the Main Street world, we really didn't do much of that, because there wasn't not that there wasn't a lot to be secure. It's just not something you thought about. But talk a little bit, Kyle, you could talk a little bit about, what we what we do on a data room standpoint. And then what I wanted to talk about at the end is really the forms of due diligence that typically we see and how intense it gets. Okay, just talk about the data room first.
Yeah, I think the most important part is to make sure that you are in control, that you're driving the bus, and you want to have as much control of your client's documentation throughout the entire process. So when you're dealing with main streets, sometimes you collect information as you go. You may even go to market sometimes before you have the complete file. In the low end market, you want to have everything up front, and when I say almost everything, a lot of times it's a controlled sale process, and the private equity group, they're going to want certain details. You don't want to have them waiting for it. You're going to be dealing with a good number of buyers, and you want to have that whole process controlled. Using a data room, you can see who accesses. So for example, normally in the main street, buyer calls you up, I'm interested in XYZ business. You send them the NDA, they sign the NDA, and you email them a PDF file. Now you don't know if they open the email, you don't know if they reviewed it, you don't know if they shared that with someone else. Typically in the low mid market, you want to control that entire process. You want to know what they viewed, how many, they actually looked at the SIM, they looked at the CBR, and they would ask sometimes, hey, can I share this with my accountant? Can I share this with my financing partner? So you could just offer a link for the accountant to gain access. So you want to have a complete data room and control the entire process, because there are some scrupulous folks out there that are trying to either data mine or try to gain a competitive advantage to see who is on the market, and this alleviates that, having a data room.
Anthony, if I could speak up, first of all, I apologize. I was on, I just couldn't get my iPad to work the way I wanted it to. So
No problem, Greg.
Great meeting today. It's really great. Monty, thanks so much for your time and your knowledge.
Thank you.
But I agree with what Kyle's saying, but I also go back to the financials. I really don't do anything unless they provide me with 3 years profit and loss and 3 years of tax returns. Because if they're not going to give it to me up front, then it's going to get hairier when we get close to the closing. So that's the way I explain it to the client. The more you give me up front, the less it gets to be a problem during the 12th hour when everything tries to fall apart. So I try to set that expectation up front. And on occasion, I have to do what Kyle said, start it without all 3 years, let's say. But, QuickBooks, especially mobile QuickBooks, is like unbelievably easy to use. It's got AI where it populates your from your bank account, it populates your profit and loss and all your chart of accounts and so on. So I think I agree 100% with getting everything we can up front and in front of it. And it depends on the size of the deal. But I would think the more you have, the better off you are.
I agree, Greg. And Monty, I think part of that comment to me is, and part of what Kyle said is, when we look at a deal, we look at what's going to be required in due diligence. Because if we can get all of that information or most of that up front, then we're prepared. We know there's not going to be any surprises. Just talk a little bit about due diligence. It's not just financial due diligence today. I mean, we find it's almost painstaking to a certain extent in terms of between, HR diligence and legal diligence, and just talk to us about what your experience has been and how that process goes, and what maybe is that, I don't know if there's an easy way to get through it, or what you use in kind of from a mindset standpoint in order to make sure that, we satisfy all the requirements and check all the boxes.
Yeah. There's nothing easy. This is the most time consuming part of it. And I'm convinced that on some of this stuff, the buy side simply want to fill out checklists, and they do download, they get data together. The teams of people who are doing that are not necessarily looking at everything. I mean, they want to see that it's there, and but it's a time consuming thing. And you're right. It's not just financial due diligence that's happening. You got human resource, you got technology, you got corporate level. Have they been maintaining their record? How have they been maintaining their record? You've got diligence simply on things such as maintenance records that they're looking at on equipment, and what type of equipment maintenance that. So you get the breadth of what's happening in a company. You're going to know fairly quickly, probably going in. For sure, you need to have financial data together. That. Okay, you should make sure you have entity level data together. If they're not buying the corporate entity or the LLC or what, it doesn't matter. Get all the stuff together that will show that they maintain the entity in a good condition so that it satisfies their concern over the structuring of the entity. Human resource, it's a very big issue. They want to know who the players are in the deal. They want to know who they want to know their backgrounds. So you need to have information on who the team is. That's that human resource side. If technology or assembly systems or any of that type of stuff are a part of the value that's happening here, you need to have data that you put together on those. Once you do that, you can be assured of one thing. There's going to be another list coming, and it's going to be big. And so as much as you think you're going to put it together, it won't all be there. But a buy side will see the sophistication that you have if you already have a data room that started. And the buy side will also know the sophistication you have if the diligence items that they continue to request are not sent directly, they're sent to the data room, and you want them to pull the data down because it's going to be critical to you to know when they get it. I've had more than one intermediary go into a meeting that was a big meeting and somebody was supposed to be reviewing. They weren't even thinking about the fact they could know when they were pulling data out of a data room. In that a couple of hours before they were supposed to have the meeting, somebody's pulling data out of there and claimed that they'd reviewed it weeks before. But the intermediary knew that wasn't the case. And so it helped them understand how to deal with things. So you just knowing, like Kyle said, just knowing who's accessing and when they're accessing, and on this due diligence stuff, having a control factor over it and having a mechanism in place so that everybody has a central location to move to. But don't think just because you get a data room set up and you get all the data down that you think conceptually you should have, don't think that's it, because get ready, it's going to be even double that probably by the time you're over.
Yeah. I find, I agree. They want to check the boxes. We had a deal we did last year that, the diligence list was pages and pages long. They probably had 27 auto leases. We had to get every lease document. I can't imagine how they really reviewed every single lease document. They had property leases. There's just so many legal documents. If I had to actually print out the due diligence, it probably would be 3 or 4 feet high. It's just insanity in terms of what it is. But having said that, that's what the requests are. And I had a couple of, if anybody has any questions, put it in the chat. I had one here from Sarah Grossman, who said she had a deal a few years ago with a PEG that didn't work out because the seller basically didn't want an unsecured note, and the attorney was not sophisticated enough to really understand that's a typical PEG requirement. How can she coach someone moving forward about this, and how can you assure them that they're likely to get paid, and do PEGs ever default?
That's a tough one. I can tell you from my background in dealing with this stuff, this comes from how well you coach and set expectations. And so it's the intermediary's responsibility to know what the market may likely look like, who might likely be the buyers out there. And if it's evident that a private equity buyer is on the horizon, you should know that. And you have to begin to coach your seller from the very beginning, get them ready. Because what most sellers say, I'm not going to finance any part of this. Okay, well, let's just get that out of the way. Yes, you probably will. And then I've got these requirements I'll have. Well, whether you do an SBA or private or some other private equity, somebody else is probably going to control that. And then when you get into private equity, you have to look at the players. So here's what I deal with. Here's the way I suggest it. If the private equity group's coming to the table, you look at the breadth and size of that group. What have they done? What's their portfolio look like? You can even get financial data on them, and you can use that to leverage the seller to see what's happening. They do not come to the table and do these deals to fall apart. The reason why is they can't maintain themselves with the portfolio that they would have. Now, obviously, that's a bad deal if they don't have a portfolio and you're dealing with the first transaction. That's a problem. But that's the way you do it. You leverage up what they've done and get the sellers prepared early enough in advance so that they understand this is your market. This is who's likely going to be here, and you will not have a guarantee on the note. You may have some collateral, but you're not going to have a guarantee on the note.
Sarah, you have any follow-up question?
No, I mean, it was my first deal of that size. It was about $12 million, and I didn't know better, right? I had never done a deal of that size, so I didn't kind of realize how to work with private equity firms. And I think the problem was his his attorney dealt with just really small deals, and he was only listening to her, and she kept saying to him, don't take a note, don't take a note. So it's just, and it kind of flipped mid deal after they had done like their quality of earnings and everything. So this is good to know that I should just get a lot of background on the private equity firm to really show that they're solid and that they will likely repay the debt and stuff. So thank you.
I'd like to expand on one thing with what Sarah's saying. This is where, when you start moving up the scale of your deal size, this is where it's super critical that you assemble a team that you have confidence in. If you can at all do it, you keep a select number of parties, the attorneys, the tax side, everything, and you know those are the people that you have confidence in, no transactions, and you try to get your clients to migrate to pick one of those parties as their advisory people. Where in the Main Street, you can just say, hey, go talk to your accountant, or hey, Main Street, go talk to the attorney, just find somebody. This is where you want to make sure that you have a secure team. They see you as the intermediary. They know you're the quarterback. They're not going to step on you, and they will do what they're supposed to. But that's because they are doing the professional thing they're supposed to do, but they still understand their area of practice, and you've assembled your own team of people. Just the best you can to do that. You need to try to do that.
Sarah, we routinely, I hate to say vet the attorney, we ask questions on a regular basis about what their involvement with their attorney has been. And typically, if it's the one who, did their real estate closing for their house, or if it was the one who maybe did their trust or estate work, and maybe it's not somebody who does transaction work, or they don't have a partner who does transaction work, we may gently suggest that they use somebody who is got M&A experience, and we typically have 3 or 4 options for them, not that they could select on their own, so it doesn't look like we basically have hand selected any one specific person for them. And it has worked successfully for us in the past, and it's helped us get transactions done, and also it's really provided a very fair outcome for the seller and for the interest and on behalf of the transaction.
Yeah, we typically try to refer in attorneys and accountants that we know. I think in this particular case, the seller had built up his business and started from scratch. So when he started, he had this, attorney that was dealing with us when it was a smaller business. But then over the years it grew, she wasn't sophisticated enough, and he was so stuck with working with her that he wasn't interested in hearing anybody else. But that's all really good advice. And at the time, like I said, I wasn't sophisticated enough as a couple of years ago to know some of these things to do with a deal of that size, of a $12 million deal. I think if I had managed it a little bit better, it may have closed, or we could have just mitigated some issues at the front end. So this has been really helpful.
Yeah,
thank you.
Great. Hey, you only have to lose those once to realize how much money you lost, so you won't let that happen again, right?
Right.
Kyle, somebody asked about suggestions for a data room, Kyle. I thought maybe you could help them with that.
So actually, Steve actually mentioned that through IBBA, which we are an affiliate group of, Vault Rooms is free. That's one service that you can use that comes with the IBBA membership. There are many others out there that you can utilize, but Vault Rooms would be my recommendation.
Okay. Yeah, we have one through our CRM that we use, so there are, I think, a lot of options. I know, Monty, do you use that one you prefer?
Yeah, ShareFile's got a great background. I've got some data. I use data rooms for a whole different reason. I'm maintaining confidential client maintenance and that files, and it's all online. Vault Rooms is a group that's been around a long time. I do think that your best solution is to, if you don't do it already, if you are part of the IBBA, use Vault Rooms. It's a way to get you integrated, get you started. I think you'll find the sophistication is there, and then you can eventually move up where you're spending maybe $1,000 a year or 15 or 2,000 if you feel you need to have the more advanced sophistication. But I think Vault Rooms is a good start. I think Kyle made a good point on that.
Yeah, I mean, if you are cost conscious, even some of the consumer friendly versions like Box and Dropbox, they have the paid version that you can use as well. It's not as sophisticated as ShareFile and Zoho Vault Rooms. Deal Room is another one, but it's a good place to start.
Mm-hmm. So that's good. That's good. So I think some people have put in the chats what they use. So you could take those and kind of evaluate and see what it is. Last question somebody asked, is there a difference in the timing of due diligence when you're looking at Main Street versus a lower middle market deal?
Definitely. Due diligence can take much longer time period, and they're typically going to lock you in for at least 2 to 3 months at a minimum. They want that exclusivity. So yeah, it's going to take a little bit longer than the Main Street deal. We didn't get a chance to go into pros and the cons and the benefits and how you can move to Main to mid-market. You could probably have a follow-up conversation. I know we are short on time, Anthony, but this is a loaded topic, and I think it might make sense to maybe have a follow-up on it just to guide folks on what they need to do to get themselves in place to help and service clients in the mid-market, from getting a team in place, not just external team, like you mentioned, having attorneys and CPAs that you can call upon, but your internal team, because now you're typically in the lower mid-market, you are more in a collaborative and consultative service as opposed to just a one-man or one-woman operation. There are more significant fees as well, so you want to make sure that all of your agreements are buttoned up, because collecting on fees can, that's another issue as well. The larger the fees, sometimes there's more, there can be some challenges there. So maybe we could probably have another follow-up, Anthony, to kind of dive down a little bit deeper if folks would like that,
I think so. My point today was just to kind of give not just an overview, give some of the nuances and some of the things that happen when you're working in the lower middle market. But, if we can work on the transition on another meeting, that would be great. Monty, we're almost at the end. I really want to thank you. I know your time is valuable. Monty is a person who, if you really need any kind of deal structuring or any kind of advice in terms of if you're doing any kind of transaction, he has the goods. I mean, he really does. And I don't say that because he's our guest. I've talked to folks who've used Monty in the past and not abused him, but used him in terms of his knowledge and his ability to make sure that your clients really get the best possible outcome. And I think that's really all our goal. Monty, I'll give you, if there's anything you have in closing, and then I just want to go to Greg, kind of just talk quickly about membership.
Well, I think this is something that's warranted for everybody. Somewhere along the way, people who are working more in the Main Street area, they have to make a decision. Do I really want to move up into mid-market, or do I feel comfortable staying right where I am? And for those who say, okay, I feel comfortable staying where I am, move your top level up a little bit, where you think maybe $700, $800 million deal is it. Move it on up and move up to about $1.5 million, because once you do, your sophistication level is going to change even a little bit in there. It'll give you a little flavor about what it is to even go further. And I think it'll help you for two things. One, you'll get a stronger revenue stream, open up a broader market for moving up, but you'll also start getting a flavor of what it is to maybe move up into a little bit more sizable deal. It'll help you decide, do I really want to move up and start dealing with $4 and $5 million deals? Or do I now feel comfortable that, hey, my top end's $1.5 million and down, or $2 million and down? And then you can stay in that space. You will have advanced your practice, but yet you've advanced it by staying inside the area that you feel comfortable with. And do this. There's nothing wrong with staying in that space. You can do really well as long as you feel good about what you're doing. Where you go wrong is when you've gotten one rung above where you feel comfortable. And so you can do this. Remember, the Lone Ranger had Tonto. So you don't do this alone. So you go out there and you assemble a team. You assemble people around you that you can have comfort in, because if you don't feel comfortable moving up to $1.5 million, $2 million, I promise you this. If you have the right advisory people around you, as we talked about, your attorneys, CPAs, any of that, if you got that team that you can go to, it's amazing how well you'll feel comfortable, because you'll learn. You don't have to know everything. First of all, you can't. When you move up into this area, you're the contractor, you're the quarterback. You don't need to know every position and every move. You got to have the people around you that know how to do that. You do that, you can move up as big as you want, but you just got to start incrementally going up a little bit just to test the market and see how you like it.
Terrific. And for anyone who needs to locate Monty, please just contact me or Monty. I don't know if you want, I could share your information with them in a follow-up email.
That'd be great.
That's okay with you. Okay.
Absolutely.
I'd love to do that. And I'd like to just close out. Greg, can you just talk a little bit quickly about membership and the fact that we're going to move forward?
Yes, I will. Again, thank you, Monty, for your participation here. It's very educational.
Thank
you. Basically, our efforts here with the New York Association of Business Brokers is to redevelop it. It's been, we've had a couple years where it's been kind of stagnant, but right now we have a major energy and a major effort to to help bring people in of all backgrounds. It could be legal, it could be CPAs, it could be business brokers. And we want to bring the population in that can help us have better meetings, such as what Monty had today. So we have a 15-month membership going on for $199. That membership is, it's supposed to be an annual, but we're giving an extra 3 months, and we'd like to see as many people join as possible. It gives us the ability to continue to grow the New York Association of Business Brokers. Our goal is to become the premium or the premier business broker association in the country, and our definition of that is high participation, high relationship building, and high value during our meetings, whether it be in person or it be on Zoom. We've also have a program for our sponsors for $300 or so, or there's one for $400, where you can participate, you can sponsor, and every time you have a meeting, you can then have a 10 or 20 or 30 second elevator pitch or a minute or whatever to better let people know what you do. But right now, we're looking for people to continue to grow the New York Association of Business Brokers in our effort to become the premier brokerage program in the country.
Right. And thanks, Greg. And, we will expand it too. I think there's been some incentive placed for us and some real interest for those folks who are in New Jersey, especially Northern New Jersey and Southern Connecticut, because we do a lot of business in that area. Upstate New York goes way far, 8 hours north of north and west of where we are here on Long Island. But Jersey and Connecticut are close. So we're going to probably turn this into a more of a tri-state organization, because we do interact. That will be our cross-border effort. The cross-border will go across New Jersey, across Connecticut, when we're permitted to come back, though, right? So, if we're not permitted to come back, you can't do it. But in the interest, it's 9:05. I apologize for going over. Monty, once again, thanks a lot. Kyle, thank you very much. And everyone, thank you for attending. Please stay safe. Have a great holiday. Whether you're celebrating Christmas or Hanukkah or any other holiday, please enjoy. And we will let you know what our next meeting is. I believe it's the last Wednesday in January. I'm not sure what the date is, but we'll send an email out to everyone. Stay safe and enjoy the holidays. Thank you.
Guys, thank you.
Thank you, Kyle, for your effort today.
Bye, guys.